Strategic Portfolio Diversification in 2025. Your guide to resilient investing. Are all your investment eggs in one basket? In the fast-evolving financial landscape of 2025, that strategy might be riskier than you think. Hello, investors. Welcome to today's deep dive into one of the most critical strategies for investment success, strategic portfolio diversification in 2025. In an era marked by rapid technological innovation, geopolitical turmoil, and evolving financial markets, knowing how to diversify your portfolio is not just important, it's absolutely essential for financial resilience. Diversification isn't just about spreading risk. It's about maximizing return by investing in different areas that would each react differently to the same event. In today's global economy, where geopolitical tensions and sudden market shifts are common, a well-diversified portfolio can be the difference between steady gains and sudden losses. Let's break down exactly how you can future-proof your investments this year while staying ahead of the curve. First off, let's address the elephant in the room. Why is diversification important in 2025? Imagine your entire portfolio focused on just one or two industries. That's risky, right? The market can be as unpredictable as ever. For instance, look at the August 2024 market dip triggered by regulatory changes in the technology and energy sectors. Investors who were overexposed to these areas felt the pinch, while those with diversified assets stayed more stable. Diversification spreads your risk across sectors, geographies, asset classes, and even currencies, shielding your portfolio from major shocks. By integrating multiple sources of wealth creation, it ensures smoother, more stable returns over time. That's the power of diversification. It acts as your financial safety net. Let's start with the basics. Diversification is the art of not putting all your eggs in one basket. By spreading investments into different buckets, investors reduce their exposure to any one particular asset's poor performance. Here's an example. If one sector, like energy, struggles, gains in another, like renewable technologies, can balance things out. So how does one achieve effective diversification? Follow these key principles. Invest across different sectors. Don't limit yourself to tech or finance. Explore healthcare, consumer goods, and renewable energy too. Diversify geographically. Global markets often don't move in lockstep. Investing in international markets can act as a counterbalance to domestic volatility. Include multiple asset classes. From stocks and bonds to commodities and real estate, each behaves differently under market pressures, spreading your risk. Ultimately, diversification is not just about making choices but making informed choices. Over the course of this video, I'll show you how to do just that. Now let's talk about where you should be looking in 2025. Our financial world is changing rapidly, and emerging sectors are shaping up to be lucrative opportunities for investors. Renewable energy. As nations strive to meet climate goals, renewable energy remains a high-growth sector. Investments here aren't just sustainable, they offer long-term financial upside. Healthcare innovations. Biotechnology and healthcare are evolving due to aging populations and advancements in precision medicine. Investors have the chance to tap into groundbreaking developments here. Digital assets. Blockchain technology, including cryptocurrencies, is no longer a fringe investment. While volatile, digital assets represent a frontier for substantial returns. Tread cautiously, though, as this space is highly speculative. International markets. Think beyond borders. Economies in Asia and parts of Africa are accelerating, presenting untapped growth potential. Exploring these emerging opportunities while ensuring you balance their risks with safer traditional assets can give your portfolio a competitive edge in 2025. Speaking of balance, let's discuss the relationship between traditional and alternative assets in diversification strategies. A sound portfolio doesn't abandon the tried and true. It integrates them harmoniously with newer opportunities. Stocks. Equities remain the backbone of most portfolios, offering long-term growth potential tied to economic performance. Bonds. With their relative stability, bonds act as anchors, particularly in periods of market volatility. Real estate. Providing consistent cash flows and hedging against inflation, real estate is ideal for portfolio stability. Commodities. Gold and oil, for instance, usually perform well during inflationary periods or economic uncertainties. Cryptocurrencies. While risky, they offer high reward potential as investors catch the wave of disruptive blockchain technology. A good mix might include 60% traditional and 40% alternative investments, though the ratios depend on your risk tolerance and goals. Here's where 2025 sets itself apart. Technology makes diversification exponentially easier. Gone are the days of manually scouring financial reports. Today, platforms like the AI-driven DiversiSmart app are making portfolio management more accessible. With real-time analytics, pattern recognition, and personalized recommendations, diversifying across various avenues isn't just doable, it's simplified. Apps like these help you identify trends across different sectors and geographies, gauge risk levels for multiple assets simultaneously, automate asset allocation dynamically. These tools enable even novice investors to feel like seasoned pros, ensuring portfolios remain balanced and up-to-date. Now let's dive into what not to do. While diversification is undeniably powerful, it's not without its challenges. Beware of these common mistakes. Over-diversifying. Believe it or not, having too many investments can work against you. With an overly fragmented portfolio, potential returns become diluted, and management becomes unnecessarily complicated. Under-diversifying. On the flip side, sticking to just a handful of assets exposes you to significant risks should one sector or geography falter. Neglecting regular reviews. The market doesn't stand still and neither should your portfolio. Ignoring periodic adjustments can leave you overexposed or underprepared. Emotional decision-making. Letting fear or excitement dictate your choices often leads to suboptimal asset allocation. Stick to data and logic. Understanding these pitfalls and how to sidestep them is a key component of long-term investment success. So, how do you go about creating a well-diversified portfolio? Let's break this down step by step. Assess your risk tolerance. Know yourself as an investor. Are you a risk seeker or risk averse? This will guide your investment choices. Align portfolios with goals. Define what you're aiming for: financial independence, wealth preservation, or quick returns. Your goals dictate your strategy. Regular rebalancing. Markets evolve and so should portfolios. A quarterly review may reveal opportunities to realign assets for better returns. Stay informed. Keep yourself updated about shifts in the global economy, industries, and technological advancements. Knowledge is power. Hire experts or use tools. Consultants or financial advisors can offer tailor-made advice, while diversification apps provide affordable expertise at your fingertips. With these strategies, you're setting yourself on a path to strategic, resilient investing. Remember, diversification is not a set-it-and-forget-it strategy. Ongoing portfolio management is crucial to maintaining financial goals over time. Here's why. Economic trends. Shift. In 2025, technological advancements, climate initiatives, and political relations will continue to sway markets. You need to pivot as these factors change. Portfolio performance evolves. A top-performing sector today might falter tomorrow. Regular evaluations clarify what's working versus what isn't. Risk profiles alter. As your life circumstances change, so does your appetite for risk. For instance, retiring investors often move from equities to bonds. The takeaway? Flexibility ensures your investments remain aligned with the broader landscape. To wrap up, remember that strategic diversification is both an art and a science. As an investor, your most important job in 2025 is to build a portfolio that's not just profitable, but also resilient against market shocks. Here's what I want you to do. Start by analyzing your current portfolio. Does it lean too heavily on one asset class or sector? If so, make adjustments. Research emerging opportunities, but don't ignore the value of traditional investments. Experiment with technology-driven tools to simplify diversification. Above all, commit to learning, improving, and adapting. Every step you take brings you closer to financial security and growth. Thank you for watching. Don't forget to like, subscribe, and hit the bell icon for more smart investing tips. If you have questions about diversification or want us to cover a specific topic, leave your thoughts in the comments below. Remember, your future is built today. Stay diversified, stay resilient. See you next time.